All right, welcome back everyone to the Nadland Forum Podcast Daily. I'm Ruby, here with Lior. Hello, mate. And today we're diving right into the buzz. Mortgage rates have dropped to their lowest point in 11 months. Huge headline, right? But here's the catch. It's not quite as dramatic as you might think.
Yeah, the rates are low, but if you look at the actual pace of the drop, it's much smaller than you'd expect after such a soft jobs report. Normally, when we see weak labor data, that just smacks the bond market, and mortgage rates really dive. But this time, most of the reaction was already baked in. So Monday only saw a minor decrease instead of that big sudden drop a lot of folks were waiting for.
It's a bit like turning up at your favorite restaurant and the chef's already packed half your meal to go, so you're just left picking at crumbs. Sorry, that was a weird one. But you know what I mean? Why does the market do this, Lior? Why is it sometimes so quick and other times, like this week, kind of slow on the uptake?
So here's how I see it. Sometimes markets react before the news is even officially out. It's like everybody is trying to outguess the next guy. Back in 2018, I remember the bond market rallied after a surprise in the jobs report. I had buyers here in New York, and we scrambled because lenders were suddenly panicking about locking in rates. People who thought they'd save a bunch didn't get much movement at all. Because honestly, by the time we got the good news, the opportunity had mostly passed us by. Happens more than folks realize.
So basically, if you blink, you might miss it. And now it's almost like the market's pre-gaming the data ahead of time and not waiting for the actual numbers. It explains a lot about why people tracking rates might feel like they're always a step behind. And that brings us to the lenders, right? Because even when rates technically drop, they're not always passing the full discount on to us. Right now, lenders are playing it careful. Tiny adjustments instead of big swings. I mean, if you hear there's a drop of 0.03%, is anyone other than us finance nerds even getting excited?
Huh? I know, right? You tell a real estate investor, hey, rates are down by 0.03%, and you get like polite applause at best. But honestly, lender caution makes sense here. They already repositioned pretty aggressively right after that jobs report, so now they're just doing these little tweaks. It's not about being stingy, it's about managing risk. If they drop too fast and the market snaps back, they're holding the bag.
That's fair, and sometimes these little moves actually do have bigger effects, don't they? Like when investors are on the fence, waiting for any signal, sometimes even a tiny rate change can get the ball rolling. As much as I joke, I remember last year, just a quarter-point cut meant the phone started ringing with clients asking, is it time to pull the trigger?
That's totally the case, especially in a tight market or with larger amounts. Those little shifts, they make a real difference. I had a deal fall into place once just because the lender decided to drop 0.05% on Thursday instead of waiting till Monday. And suddenly, everything lined up for my client. But overall now, I'd say the tone is measured. No one's going wild, and most people are just being careful.
So cautious optimism, yeah? Less let's party and more let's not drop the punch bowl. I'll stop with the bad analogies, but this really is a different vibe from the volatility we saw just a year ago. Looking ahead, because there's always another twist, what everyone's watching now are those next data drops, right? We've got the CPI report coming up September 11th, and then the big one, the Fed's decision on September 17th. Feels like everyone's just holding their breath to see if these low rates stick around or if the rug gets pulled out again.
Absolutely. Those data releases could change everything. But, the outlook's kind of hopeful, at least in the short term. If the next reports keep supporting a strong bond market, rates might drift even lower. And that's good news for buyers or anyone thinking about refinancing. I actually had a client not long ago. She was watching the calendar, timing her refi application, waiting to see what the Fed would say. When the Fed finally left rates untouched, her timing paid off, and she locked in a great deal. It just goes to show, if you pay attention, there are opportunities even in slow-moving markets.
And it doesn't need to be some huge dramatic shift either. Sometimes just staying informed, having patience, and let's be honest, a bit of luck can make a real difference for buyers and homeowners out there.
Yeah, we've had a lot of episodes lately digging into this. Like when we talked about smarter investing or even that national housing emergency idea. But it always comes back to timing, right? What you know when you act and how you interpret the flood of data. That's the key.
All right, so for anyone listening who's in the market or just rate watching for a better time to refinance, don't lose heart. The opportunities are still there, even if they're hiding in plain sight. And as always, we'll keep tracking all the shifts for you so you don't have to brave the data jungle alone. Lior, lovely chatting as ever.
Thank you, Ruby, and thank you to everyone tuning in. We'll be back soon, so stay smart, stay curious. Catch you next time.